What is the difference between standard deductions and itemized deductions? Could you explain that?
Yeah, so that is on your personal tax return. So nothing related to business returns or anything like that. But every person filing a tax return gets what's called a standard deduction. This year it's $13,850. So if you're married, it's double that. So let's say for easy math, 28,000 is your standard deduction if you're married in 2023, which means if you had $100,000 of income, you automatically get to take off 28,000. And so now you're only taxed on 72,000. That is the standard deduction. Now you can choose to itemize. You'd probably only itemize if you're over that $28,000 because you automatically get 28. So it's either you get the 28 or you get itemized if it's higher than that. And what itemized deductions is comprised of are all of your medical expenses for the year, your mortgage interest, your state tax, your charitable deductions. Those are like probably the top four that can get you over that 28K mark. Now, if you have a pretty low mortgage amount, you're probably not hitting that 28,000 mark. So something I hear a lot that I think is a big misconception, especially in the real estate industry, is buy a house because you're going to save money on taxes. Well, since the standard deduction was increased so much over the last couple of years, a lot of times you don't actually get a benefit from buying a house anymore because your mortgage interest isn't more than 28,000 a year. Now, if you're in California, you're probably over the 28,000 because houses are expensive. But they also limited the mortgage interest to 750K. If you have a mortgage over 750, you don't get to take the mortgage interest above that.